Hello, everyone. Welcome to our 2025 Hiring and Salary Trends webinar. I see a lot of people are still coming in, so let me give it one more minute and then we'll get started. Okay. Before we get started, Jen, let's just make sure that we can hear you. Can you just say 1, 2, 3 or something like that? Okay. Jen is our second speaker and she's working out a few problems, but let's go ahead and get started. Welcome to 2025 Hiring and Salary Trends. And just a couple of housekeeping items before we get started. We are taping this and we will send out the slides and the tape either later today or sometime tomorrow. Please ask questions in the right-hand side. There's a chat and a Q&A only. Please put your questions in there and then we will answer those questions at the end of this webinar. So first, just to give you a little bit of background on Chmura, we provide labor market data and analysis to help your communities and businesses thrive. We're a team of about 60 economists, data scientists, statisticians, business professionals who really care about helping you grow your community and business. We have a software side. Many of you use our Jobs EQ, and then also a consulting side where we do all kinds of projects on policy, labor, strategic plans, et cetera. We were founded in 1998, and we have offices in Richmond, where I am, in Cleveland, Ohio, and we really are driven by your satisfaction as clients, and a top priority is excellence in our services. So a little more background on the markets we serve. Here you see corporate, economic development, education, staffing, site selection, and workforce. In terms of some of our clients, you can see the top consulting groups often use Jobs EQ, Deloitte, and Ernst & Young are listed on this sheet. Workforce, economic development, corporations, all education, all use Jobs EQ to help them see what the labor situation and atmosphere looks like. I'm happy to say that Jen Dodge will be joining us today here. I will be pretty much showing you the national economy, a lot of the data, and we have many cross currents out there. And Jen will join us on talking about how businesses are reacting. We're really happy to have her join us today to give a view from hiring experts' perspectives. Jen has almost 30 years professional recruitment experience, and she's hosted me many times to share economic insights with her clients over the past couple of decades. So Jen, can you take a moment to share your background and the perspective that you'll be sharing today? Since there is silence, I am thinking that she is having issues on her end. So let me continue and just give some background. So she's with LHH, which is part of Adecco, which is a global recruitment firm. So you can see on the left-hand side some of their solutions. Not only do they do recruitment, but they have leadership development and coaching, upskilling and reskilling, which is really important at this point in time, and HR talent advisory. On the right-hand side, the areas that they mainly help with are accounting and finance, HR, technology, legal and compliance. And I know in talking to her over the past couple of days on this, she has some great insights that she will be presenting. And so I'm hoping that we get those issues resolved so that she can be on the line with us. So, when we first came up with this topic a few weeks, actually, it was a couple of months ago, it seemed like a typical and almost even boring 2025 hiring and salary trends. And the last couple of weeks, we have seen a lot of change because of all of the uncertainty. And so the title here, How Will Policies and Cyclical Changes Impact the Labor Markets? I'm going to start by giving you a framework in which to think about all of these changes. So our first topic there at the top is the primary policy drivers. And I'll explain more of that on the next page, but it's really important, I think, that we sort of level set ourselves and look at, so what is driving all these changes that are taking place? Then we'll look at more of the business concerns, the secondary effects. And I've broken that down into two parts, basically two parts. Policy. So we've seen federal workforce cuts, we've seen tariffs, and it's all because of these drivers that I'm going to show you on the next page. And then we have cyclical changes that are coming. Recession. A lot of people are questioning, are we even in one right now? And then we have Fed policy. So, and then I threw in, everyone's talking about AI now. So we're going to talk about that a little bit at the end there. What is the impact on the labor market? Generally, we're seeing a softer labor market. It's coming back closer to a more normal labor market after the gyrations we went through with COVID. Toward the end, then, it's really important to see what the skills and the salaries and the labor demand is at this very moment, because it's changing so quickly. So we'll have a live look in our Jobs EQ software. That we just added a tool called Salary Sonar that gives us some really good up-to-the-minute information on skills, salaries, and demand. And then, of course, please put questions in the Q&A, and we will take that at the end and answer those questions. So the four factors driving the current administration policies as well as business actions. So at the top there, the primary policy drivers are things that have been with us, not for the past 6 months or 2 years or 10 years, but have been issues for the past decade. The trade deficit has been growing. The federal budget deficit has been growing and too large. Immigration reform has been needed for many years. And then we always have productivity. Are we seeing gains in productivity, or is it slowing? And that's very important in terms of the growth of the economy overall. So on the trade deficit side, because of that, we see tariffs from the current administration. Because of the federal budget deficit, we're seeing all these federal layoffs. And because of immigration reform, we have labor availability issues, and then efficiency savings with productivity. So then at the very bottom there, you see the secondary effects that we have are business concerns. So because of all these other things that are happening, because of these structural issues that we've had for many years, we're seeing interest rate impacts, we're seeing the stock market drop and increase, and we're seeing changes in unemployment and wages. And again, these have all been around for decades, but now they are even bigger issues that are being dealt with. So first, the primary policy drivers. Let me show you some historical data from this perspective. And on the left-hand side, first you see the trade balance deficit, and it's huge. The last couple of months are probably an anomaly. That's because companies are buying goods, having them imported ahead of the tariffs. But even so, if you take out the last 2 months, the trade balance has gotten larger since COVID, and it continues to remain large. We're a consumer of goods. We consume a lot more than we export to other countries. As a result, other countries have dollars when we buy their imports to spend, and then they purchase our bonds, stocks, etc., with that money that they got from us by us purchasing their imports. On the right-hand side, then is the federal deficit. So we're looking at this deficit going all the way back to 1900. It's as a percentage of GDP. And the last spike we had in the 1940s was because of the World War that we were spending on at the time. If this is unsustainable, it's very large, and at some point we're going to have to deal with it. If we were a third world country, our dollar would not be worth much. It would continue to weaken because of the huge deficit that we have in terms of as a percent of GDP. The reason why people continue to buy our bonds and stocks and the dollar stays strong is because our economy is one that continues to grow, and we have a very stable environment in terms of political and business relative to other countries. So, like I said, this problem is not new, and I don't know how many of you remember Ross Perot. We could be dating ourselves here, but he, in 1992, he was an independent, ran against Clinton and Bush. Of course, Clinton won at the time, but he was famous for this diagram that he would show of a hockey stick. And basically, he was saying, as our debt starts to increase like a hockey stick, we're going to start to see interest rates going up because people are not going to buy our debt. So, and again, when I give talks often, typically someone will ask about the deficit. Well, what about the deficit? It's so large. When is it going to decline? And my answer is that it probably won't until we see a watershed event. Who knows what that event is going to be that causes international people to wake up one day and say, I'm not going to invest in the U.S. anymore. Then that would cause our interest rates to go up, and it will finally get on the minds of Congress to do something about it. Well, maybe we won't have to wait for that event. It appears to be on the mind of the administration. So again, these are structural issues that we're seeing being dealt with right now. Another longstanding structural issue has been immigration. So here we're going all the way back to 1820 to show you the number of immigrants. An interesting chart that shows you where we saw most of our immigrants coming from. At first, they were Northern and Western Europe, and that changed over time. But basically, we had an Immigration Act of 1924. We, in the U.S., let people in, so many people from every country. So Russia would have a certain number of people. Europe would have Denmark would have a certain number of people. So once we met that number of people, we wouldn't bring in any more individuals from that country. In 1965, we had a new policy, and we dropped the origins quota in favor of immigrants that have relatives in the U.S. or employers need these people in terms of their skills. So you can see after 1924, we did see it drop somewhat in terms of immigration, and then it continued to rise. Clearly, we need immigration reform when you look at this slide. This chart only goes up to 2012, so let's bring it forward with some additional data. And here, it's you bring it through 2024, and also this source broke out the number of immigrants by the reason for migrating here. And so you can see the light blue at the very top. The largest proportion over the last 3 years of migrants have been those coming to the U.S. for humanitarian reasons. So again, immigration is something that needs to change. So if progress is made, and I'm underlining if, a generational paradigm shift might follow or will follow. I'd say might. And here I'm showing you a picture of the flat world, and there's Columbus sailing across. And will that paradigm shift be as great as civilization learning the earth is not flat? I'm not sure about that, but it will, if we see progress, unleash stronger growth. So, but let's come back to the year at hand here. And during this period of uncertainty, Jen and I are going to walk you through some of the short-term changes that we expect to see in the economy. But I think we need to make sure we ground ourselves in this framework that is really driving the actions that we're seeing from a policy and from a business perspective. So with that, let's look at these secondary impacts in terms of the impact on employment and on wages. First policy perspective to look at here is we need to reduce the federal deficit. So what we're seeing is a reduction in federal workers through layoffs. So on this chart, you're seeing 247,000 federal layoffs have been announced to date. And here you can see it by the department. And if you're interested in reading about this in more detail, we have a blog that's at the bottom there that you can click on later. Much of these layoffs are concentrated in DC, Maryland, and Virginia, but not all of them. And here from that same blog is a map of the U.S. where the darker red areas are where you're seeing the greatest amount of cuts. So here's our first test, Jen. Can we hear you? Have your colleagues see any impacts of the federal government layoffs, particularly around DC? And has there been an impact with people not being 100% remote anymore in terms of labor availability? Okay, so that to me sounds like we're still having problems. But I'm gonna set this question aside and see if she does get back online here, if she can answer that. All right. Another problem that we're having is we need to reduce the trade deficit. And the way the administration is dealing with that is to add tariffs. So here is a chart from Morgan Stanley that they produced a couple of days ago. It's changed now since Trump has reduced the deficits, but had we seen him continue with what he had announced on, quote, Liberation Day, the effective rate of tariffs would go up to 17 to 22%, which is something that we hadn't seen since the 1930s. So again, it won't jump as much given the latest information, but things are changing. We're looking at the effective tariff rate, which is the tariff amount paid on all imports divided by the value of all those imports. So tariffs clearly are having an impact on the economy. And then the next question we have is regarding the cyclical issues. So there are some people who say that we're already in a recession. Actually, yesterday, JP Morgan raised their recession odds to 60% probability of recession happening this year. And also CNBC did a survey of 22 CEOs, and 69% of them expect a recession, half of them expect it to come this year. But the qualifier is they expect a recession if the current trade policy proceeds in its current form. So that's the big question there. But most people think that we qualify a recession as two negative quarters of GDP growth. And actually, there's a group called the National Bureau of Economic Research that looks at monthly data to determine whether or not we're in a recession. And here are 4 of the 5 big indicators they look at. They look at the change in employment, and notice that employment is slower than it was when we first came out of COVID, but still this past month we had a bigger increase than most people expected, to over 200,000. Below that, industrial production, manufacturing, utility, and mining production drops off, and you can see how it dropped off during the COVID recession, but it continues to grow. Real retail sales also plummets during a recession. We're seeing it kind of stabilize, came down a little bit, but nothing dropping like we might be going into a recession. Consumers make up about 2/3 of the economy, so that's very important in terms of our growth. Real personal income is on the last chart here, and you can see that it's continuing to grow. All of this suggests that no, we're not about to drop into a recession. But you may be saying, what about the stock market? It's been going down. Well, the stock market has actually predicted 9 out of the last 5 recessions. And an economist, Paul Samuelson, was the one who sort of coined that. So stock markets decline sometimes when we don't go into recession. So we still don't have any data yet that's pointing us to we are in a recession at this point. Some trends here that LHH is seeing. And Jen, if you are online, just hop in. Employees are open to exploring their options. So 47% are actively looking at open roles. 33% think about their career plans daily or weekly. And 72% contemplate their future at least quarterly. So we need to make sure that for those employees we do have, that they are happy on the job where they are right now. Some other data in terms of the job market, the unemployment rate remains fairly low. And on this chart, I wanted you to see in particular, the unemployment rate is inching up a little bit, but it's lower. It's just slightly higher than it was before we went into the COVID recession. So nothing like a strong increase. I showed you the recession before COVID because this recession is so odd. I think we need to go back and look at one prior to that. And you see that the unemployment rate, as we go into the recession, starts to increase. And then below, we're looking at wages. And here you can see lately wages have been slowing or decelerating. They're only up 3.8% from a year ago. That's data as of March. And here you can see at the end of the last expansion before we went into COVID, it was very strong. And at that time, wages were rising 4% year over year. But typically, we're seeing wages in line with the rate of inflation. So when the Fed does get back down to that 2% target that they're looking for, expect to see wages increasing at a 2% year over year rate again. One more chart here on the economy is quit rate. So this comes from survey data. The survey started back in 2000, and basically people don't quit their job during recessions. Here you can see in gray, you see people not quitting as much because they're afraid if they quit their job, when they go to a new company, maybe that company is going to start layoffs and they'll lose their job. So during times of uncertainty, people don't quit as much. Remember the great resignation that happened after COVID. So we saw quit rates at the highest rate that we had ever seen. It was hard to hire people during those times. We were seeing all kind of increases in wages during those times. And the quit rate has been coming down and more normalizing. And now we're seeing wages that are not up as much as they had been 2 or 3 years ago. Last policy issue here is Fed rates. Here you see the federal fund rate going up, and it's been coming down. The federal fund rate is the only rate that the Fed can directly affect. It's the overnight rate that banks use to lend to each other. But when the federal funds rate goes up, so does the 3-month and the 6-month, sort of in lockstep. And you see it moving up the curve. At the long end of the curve, the 10-year and 30-year are more based on inflation than on Fed policy. But in any case, the Fed always says that it's data dependent. But during this time of uncertainty, I think data dependent brings a whole new meaning. And clearly, it's hard to predict what the Fed will be doing this year without seeing the impact of what some of the administration's policies are going to be on the economy. So with that, some slides from Jen again on the fact that AI is here with us now, and a McKinsey report on the left-hand side there indicated some of the, actually I'm on a different slide. Here we're looking at, sorry, I was ahead of myself there, but even so, on the right-hand side, my current skills are transferable to other other roles within my industry. So accountants say 62% say that they are. 65% of financial services professionals say they are. And then those who say their skills are transferable to other industries, a smaller number, 57 with accounting professionals and 62% with financial services professionals. So I think from that perspective, it's important that people have the right skills and continue to get skills. And so for those of you who are educators on this call, it's certainly important to know what businesses are asking for. Some more AI trends. I'm going to skip over this just in light of time. And then actually, this is the one that I was addressing earlier. And we saw a McKinsey report who, from a 2022 study, found that the highly sought after skills were programming, data analysis, collaboration, and communication. And we're going to see that in Salary Sonar when we look at it. And based on their analysis, they were expecting employment for industrial engineers to grow 12% from 2022 to 2032, making 22,800 openings for that occupation every year. And they were expecting mechanical engineers to see growth of 10% over the same decade, creating 19,200 openings. So again, some important skills that hopefully colleges are helping steering students toward in terms of their degrees. So conclusions then on the economy side before we look at some more trends on a daily basis or some daily numbers is that the labor market, it is solid based on the employment numbers, based on unemployment, based on the quit rates, but it's continuing to normalize down from where we were during COVID. Our forecasts will continue to evolve as we see the Trump policies roll out. We're seeing some progress made on the budget. That's going to be very important in terms of growth overall. Deregulation will promote economic growth, and the Federal Reserve is closely watching tariffs and immigration for inflationary impacts that will drive their behavior. One other item here on the economy before we jump over to looking at more recent data. We have a recession probability index that we actually just updated this morning. It's based on stock prices, the S&P 500 that is, the slope of the yield curve, the volatility of the yield curve, and inflation, CPI. And we've been tracking this for some time. I have even before starting this company, but it typically, if it jumps to above 50% and stays there, we end up in a recession. And here, our latest data as of this morning took the probability of recession. This predicts 6 months out, putting it at 22% for September 2025. And you can see in the prior months, it has been very low, but the financial indicators have been, as you all know, have changed rapidly over the past month, and that's caused this probability of recession to rise. And this index that I've been tracking for over 40 years has been pretty accurate in terms of predicting recessions. So with that, let me now shift gears and take you to Salary Sonar. And I'm going to basically look at, within Salary Sonar, we could define, price, and hire workers. But what I want to concentrate on today is just the changes in skills that we're seeing. And specifically, we're going to look at three. All right.
Oh.
Jen, better late than never. So,
all right, I'm back. You finish what you're saying, Chris.
Okay, so let me ask you just 2 or 3 of the questions that we've missed, and then while I'm getting Salary Sonar up here, and one was the federal layoffs. When you talk to people, especially in DC or Maryland, some of your associates, is that having an impact on the availability of workers or on their wages?
Yeah, so I think anytime a large employer announces, definite or even potential layoffs, right, there's a huge psychological and social effect that follows. And, from what my DC colleagues are telling me, you can't go anywhere in DC without the topic coming up, right? So overall, there's certainly a big fear out there that is coming along with all of it. So overall, I think you see a few things resulting from the layoff announcements. Of course, you have job seekers that have actually been impacted and are starting new job searches. You have job seekers that are worried and have, started to what we call softly look for something new, even though they haven't received any official notice of a job loss. So it's the fear of it.
Mm-hmm.
But on the flip side, you also have the impact and the effect that kind of the human psyche has on the employers, right? So people who, or companies that might be reliant upon federal funding, some of the NGOs, and they may show a hesitation when it comes to the final moment of pulling the trigger on a job offer for a much needed hire. So, you kind of, I think so much of it is just the human psyche behind it, the psychological impact of anything like that. Chris, I think back to 08, 09, right, in Richmond, when we lost two huge employers overnight, right? And it just the psychological of when is this going to happen? Is it going to happen? It makes everybody shift a little bit the way they're addressing things in their hiring. If I look in Richmond, that's kind of up in DC, right? In Richmond, another big thing we've seen is, there are federal employees who took jobs remote during COVID, right? And now they're being asked to come back in. And, similarly, that's a hard word to say, it's the same effect we see with other companies who are asking folks to return to work, right? There may be people who took the job.
Uh-oh. It looks like
and now that they're going to have to return to work, they need to start looking for something else. So, those I think are some of the trends we're seeing.
Yeah. What about with regard to tariffs? Are your clients concerned about the uncertainty, or are you seeing, I know you had talked about the enterprise resource planning space with regard to tariffs driving things in manufacturing?
Yeah. And I'm sorry, what was the beginning of that question? The tariffs?
Yeah.
Okay.
What's that causing? Is that causing uncertainty? Are they not hiring? Or, and I think you had talked to me about the tech practice and enterprise resource planning in that regard.
Yeah. So, in anticipation of this event, I did reach out to several leaders at our clients and ask that specific question, right? Do you believe uncertainty over tariffs, interest rates, or federal cutbacks are causing you to take pause on any decisions to hire or expand? And I'd say, what's interesting is despite the uncertainty in the market, what I've heard from most of my clients is that they're not slowing down. And, although client leaders are certainly watching the announcements and the market reactions closely, I think they're all much more focused on, staying true to their strategic plans and the strategic initiatives that they put in place. So, there may be an element of, what's really going to happen out there, or, are these tariffs just negotiating tactics? So, you may have a company that is being cautious and strongly researching how tariffs could impact their pricing or any potential increases they'd have to flow through to the customer. But that doesn't mean they're going to stop what they're doing and what they think they need to do to grow their business. It's not like a one size fits all. I think in hiring specifically, I'd say that most clients, most of the clients we work with are certainly very thoughtful and deliberate in how they add headcount. So, there's always hiring that's critical to the success of the business. And I'd say that those companies are still building things and still need people to do things, and they need to keep hiring to keep business moving and growing. To you, the point you were making, I know I'd shared an example with you on enterprise resource planning. So, that I think is a really great example where, with the tariff talks, our direct conversations with tech leaders are uncovering that clients in the manufacturing, supply chain, distribution, and construction industries are really investing to find long-term cost savings through modernization of their ERP systems. So, and we talked about that a little bit too, Chris, how, when I look at trends, I see that during COVID, I think overnight, everybody really need to become more technologically advanced, right? Everybody had to figure out how to do things more in a remote environment and digitally. And it caused a lot of companies to really step up their plans on investing in new systems, right? Big data and analytics and AI, right? And now you've got companies who are 2 or 3 years into those investments, and it's really we need people to help support all these systems, right? And AI is definitely a trend, and everybody's investing in it, but it's definitely hand in hand with, I guess, up-tiering the skills of the people to be able to support all the technology that we're putting in place, right? And, definitely in companies that are in the supply chain distribution worlds, the manufacturing worlds, if they're thinking about tariff talks and how they can find cost savings, they're looking at investing in good systems and enterprise resource planning systems to bring their costs down.
Yeah, that's a good segue, Jen, to our salary sonar and some of the skills that I'm going to look at. So let me look at that real quick, and then we can go back to questions. I see there's a lot of good questions out there right now. But this is salary sonar using data from Jobs EQ. And with so many changes and the uncertainty, it seems that now is a really important time to have up-to-the-date information on salary data and linked to skills. So just real quick here, this is the opening page of Salary Sonar, and you can put in some text, for example, finance manager and or some skills, and it will pull open for you the job description or a job posting for you to use. Or you can start on a search here. What I'm going to do is show you some pre-made queries that we have with geared toward showing you how quickly wages are changing for some of the issues that we discussed and for some of those things that Jen just mentioned right before we jumped into this. But first, let me show you this one. This one pull here for jobs. Well, what I'm doing is I'm looking at any jobs that contain software developer, job ads that is, or software engineer. And I'm also asking to isolate these two skills. So you have to be this job title with Python and JavaScript. What we have here is information to strategize, then to benchmark your salary, then to source the candidates. So on your first page, just quickly here, showing you the information that we have. You're looking at some high-cost regions. So if I'm looking at the New England, which is the query that I'm running right now, where is the area where it's the least cost of wages? Here on the right-hand side of the map, you see where most of the individuals are, the darker blue. And then as we go down, you're seeing the companies who are competing for these workers. Fidelity Investment is number one. So who are your competitors and who should you hire from or steal these workers from? Highlighting Fidelity, 6% of the people that work at Fidelity first were at Duke University, 3% were at Cornell. I think maybe presumably graduate students getting degrees in finance here, or doctoral degrees. And then after working at Fidelity, 3% of the workers go to IBM. And then the skill signals. So these are skills related to those skills that you're looking for. So computer programming and coding is number one here. And then we see the growth rate of those skills over time. So TypeScript increasing, computer programming and coding is actually decreasing. So back at the top then, the benchmark salary. Just again, a quick overview before I show you some trends. We're looking at the information that you, if you are an HR person, can change, whether you're leading the market, meeting it, your salary range, how close you want it to be to your actual budget. And then we could look at that detailed information relative to the market below. But what I really wanted to show you here is the change that we're seeing over time. So for these software developers and engineers with Python and JavaScript skills, we've seen a slight drop in wages. These are job postings that are updated on a daily basis. And now you see the salary ranges by years of experience. One more quick thing to show you before I show you some of the other trends that we're seeing here is software engineers. There are 423 candidates out there with the title software engineer. Currently 33 work at Google. And again, we're looking at people living in Boston. Cambridge is 1,000 of those. But I like this close match here. And what this is showing you when we look at the close match is we're leaving out either Python or Java and saying we only need one of those skills. So here you can see these individuals have one of those two skills. And if I clicked on this, I would go to the candidate's social media. But one really important best practice that we've learned here is that often when we create job posts as someone who's trying to find an individual, we have 20, 30 different skills that we're listing and looking for. Using this tool, if you put in 20 or 30 skills, you are limiting very much the candidate pool. So really, when you're working with individuals that are trying to hire, you need to ask them, give me the 3 most important skills. Let's look for those, and I'll find you the candidates there and go from there. Because if you put 4 or 5, actually, when you start to 5, you're really reducing the number of candidates. So that's a best practice for hiring managers. Get the top 3 skills or so to start to look for in the job market. So let me go back now and give you those examples now that you've gotten a little tour of what Salary Sonar does. And my first example here is going to be in manufacturing. And what I did here is I took the CTE cluster for manufacturing. That is the occupations that are within the CTE cluster. So any of you with career and technical education, you probably can relate to that most in terms of the occupations we're looking at here. The first thing that we see is there's over 1 million job postings, but that's down 17% from a year ago. When we go down to the skills, and this really ties into what Jen was telling us, look at this. The skill that is the fastest growing, grew 198% over the past year, is predictive maintenance. So most likely, we're looking at a lot of these manufacturers that are adding AI and other productivity, efficiency tools, and now needing people to be able to maintain that. If we look on the See More here, it's going to pull open all of these skills, and predictive maintenance is at the top. 12,000 openings. Notice that the wage is 54,000, and that's a better wage than the average wage that we're seeing for all of these occupations that we're looking at, which are, by the way, for across the country. Now let's take a look at the benchmark salary data. And basically what I want to show you here is the median salary over time. And notice that it grew rapidly back in the June, August, and it's been flat since then. In fact, it started to decline. We need to watch that closely to see if it continues to decline. And is that perhaps because of the tariffs? Maybe supply chain issues where some people are losing their jobs. So we're seeing a little bit of a drop off in wages there. But again, that's just the beginning of perhaps a trend. And these are daily data, so we need to watch it and see if that changes. Going back again, let's look at another occupation that we talked about here, and this time IT occupations, and let's see how they're doing. For this one, I queried job titles. I put in, show me all the ads for the US that contain IT manager or IT specialist. And here, going down to the cost-effective regions, you can see some of the more cost-effective regions for these jobs. We can click on See More, and we have additional data that we can look at here, including the candidate to job posting ratio. So if I click, it will then rank order. So both Minot, North Dakota, and Columbia, South Carolina would be the hardest places to find these types of occupations or job titles, because there are only 1.63 candidates per posting, per job posting. So those would be the hardest to fill. Also, in terms of salaries, here at the top, interesting, the average salary for all these posts are $119,000, up 7% from a year ago. When we look at the median salary over time, look at this huge increase that we're seeing in terms of the salaries for these jobs. And like Jen said, with all these AI systems coming on board, the demand for IT skills are probably being driven upward. And yes, we're actually seeing that in the data. Let me show you one more example, and then we'll get to your questions. And that last example is AI supply and demand. And in this case, we did a keyword search. So we put in the keywords artificial intelligence, machine learning, and generative AI. And we said, show us all the job ads that have those keywords in it. So we're assuming that those skills are needed. So from this perspective, let's go down, and we were looking at job postings. They're up from a year ago. Oh, let me make sure that I'm running two things together. Job postings are up 74% from a year ago. So this is clearly in a lot of demand. If we look at the companies that are hiring, Amazon, Meta, and Deloitte are at the top of the list. Let's see who else is hiring around the country. And here you see a lot of the high-tech companies. You see a lot of banks, and we even see Mount Sinai, a hospital, up in the top list. Accenture, Ernst & Young, a lot of the consulting groups, PwC. And then finally, let's take a look and see how the salaries look for these particular jobs. No surprise, we're seeing a huge run up in salaries over time. So this is just a glimpse at being able to look at more real-time data that allows you to see the changes that are occurring not on an annual basis or on a quarterly basis, but really on a monthly basis, or actually on a daily basis. But you see these trends, this trend starting in January and really picking up steam over the past couple of months. So with that, I'm going to stop sharing and go back. And I did see one question that I wanted to address first, because is it Kay? Where was it? I'm trying to find it now. Kay, you have a very good memory, better than I wish you had. So Kay is saying, in a previous webinar, didn't you say that we were due for a recession in this time frame because of the inflation and Fed changing interest rates? Yes, we were looking for a recession, in part because of the inverted yield curve and because of the actions of the Fed. That has not materialized. The Fed typically does not have what we call a soft landing, which is that they raise rates and then they start to bring them down without us going into a recession. So far, we have not ended up in a recession. So we've kind of, looking at all the data, it looks like the Fed has skirted recession. But having said that, if we continue to see all this uncertainty, and if we go back to these huge tariffs, then that certainly can have an impact on what we see going forward. Jen, I did want to ask you, I guess, one other question that I had earlier that we didn't get to cover, but when we looked at the quit rate, and maybe you addressed this already, are you seeing job seekers still worried about the economy slowing too much, or is that not much of an issue?
No, I would say it's not much of an issue. And I don't know who's got the slides, if it's you or Mike, but if you want to go back to slide 20.
Sure, I'll do that.
I would say, employees and job seekers seem to still be very, very confident in their own skills. I think that's definitely a shift we've all seen from what the employment market was like, 20, 30 years ago, where people more identified with the specific company where they were working versus their own individual skills. But, this was one of the market trends our research showed at the beginning of 2025 is the number of people that are really, thinking about their career plans or thinking about their future on a daily, weekly, quarterly basis. I think you see a lot more people out there who they don't seem to be particularly worried. They want to develop their skills and make sure that their skills are transferable. I think we saw that in one of those AI slides that I had up earlier too, that, something like 66% of job seekers in just about every professional category, right? Whether it be accounting, IT, supply chain, most people, even with all the changes coming with AI, feel that their skills will be transferable within their industries. And I mean, those are pretty high numbers.
Yeah.
When you think of the fear that could be out there.
Yeah.
And, I think that's why employers really need to recognize it's still somewhat of a candidate-driven market, right? I mean, we call these passive job seekers, and these are people who, they may be happy in their jobs, but they're kind of always thinking about, is there something else that's better out there? And, the high number of passive job seekers makes the need for human talent initiatives all that more important, right? That employers have good strategies to attract the best talent, to develop the best talent, upskill them, and retain them. Those strategies in any company are so much more important when you have professionals that are that confident in their own skills and where they could go.
Yeah. So here's a question, Jen, I think for you that Michael asked. Have you seen any changes along the lines of skilled-based hiring? This has been a topic of workforce development for a while. But wondering if businesses have been fully adopting the practice in this realm yet, that is skills-based hiring.
Yeah, so I would say yes. I think there is. So we have one of our companies under LHH is an upskilling and reskilling company, and the name of that company is General Assembly. That's under our LHH fold, and there has definitely been an uptick in the number of clients seeking out those services and looking to use those services. And, kind of, can you hire maybe somebody who has these core competencies and these skills, right, that could fit what you need, and then could we just train them and put a training program together So hiring for the core skills, but then putting a training program together to teach them your specific software, perhaps, or your specific ERP or things like that. So yeah, I would definitely say that there's been an increase in the trend of folks really focusing on the core competencies and the skills, and then kind of training and tweaking for what you need for your particular organization. I think that's the question you were getting at, Michael.
Yeah.
I hope that answered that.
Yeah, Michael, if it didn't, ask again. We had a couple of people asking if Salary Sonar is an upcharge if you already have a subscription to JobsEQ, and it is, and the price varies based on what you currently have. And so reach out to your customer relationship manager or your account executive, and you can ask them that question. We had some interesting comments here about the debt. I like this one. Is like a crazy aunt that we keep down in the basement, and all the neighbors know she's there, but nobody wants to talk about her. Yeah, we all know that the debt is too high, and I'm glad to see that the current administration is trying to do something about it. Given the framework and all the trends that we've had, certainly these are things that need to be worked on. Many people would disagree on perhaps the route that is being taken to work on these issues, but bottom line is we need to see changes, and those changes will, once they are implemented, will have a big positive impact on the economy in terms of growth in the U.S. here.
Chris, I would just add a comment too on Rory's comment in the chat. Mm-hmm. Asking about, we're bracing for an increase in unemployment and a slower hiring market, and then the jobs report comes out and announces more jobs, right? Mm-hmm. And I think with all of this, when we were looking at the unemployment claims that you were looking at, and then wages, right? And that's something we didn't get to talk about as much since I didn't have any audio at that point. But it's not a one size fits all, right? And I think that's what people need to remember when we're talking about jobs and unemployment and hiring is, we can look at the macroeconomic level, right? But, and Chris, you and I talked about this the other day when we were talking about just here in Richmond, what a diversified market it is, right? So we have so many different industries, and you have so many different skill sets and a lot of niche skill sets out there in people who have become very, very, specialized in what they do. And it's just, you could have, unemployment maybe affecting one particular group or one particular labor category or one particular industry that could be completely offset by somebody else who's hiring like crazy because of what they need in the market at the time. So I think that's what's always so hard is looking at these things and just thinking about it always depends, right? It's always it depends. You were talking about the wages. You were showing the wages jumping up for tech people. And you and I were talking the other day about how I think 2 years ago that happened in accounting, right? It was like 2 summers ago. All the big four jumped up their salaries on like the 2 to 5 year experienced people. And there was this ripple effect through the whole market. For anybody trying to hire accounting jobs, it was just completely out of control with what you needed to offer people. But I feel like that's normalized a little bit in accounting now. Mm-hmm. But, we're definitely still seeing it on the tech side.
Yeah. Well, thank you, Jen. Great insights. I'm glad you were able to join us, and we've hit our 3:00 here. So thank you, everyone, for joining us, and please let us know future topics that you'd like to hear about. And again, the tape and the slides will be available later today or tomorrow. They'll be sent out to anyone who signed up for this. Thank you, Jen.
Yeah, thanks, Chris. Sorry
You're
about the
welcome.
audio early on, but glad it came in.
Sure. Thanks. Yep.